I'm Phil Cock of Partner Capital Group. We're representing RPM Living Investments as semi-exclusive placement agent for the fund. My cousin Byron Cock co-founded a predecessor to RPM 20 years ago. My extended and immediate family have been investing with RPM since the beginning, including in the current fund. And I'm here today to introduce John Eckel, a partner with RPM Living, who will present the Opportunity Fund, which will have a final close in January, 4 months from now.
Hello, everyone. Great to be here with you today. And thanks for that very nice introduction, Phil. And Marty, thanks for having us today. Let me know how you're going on the...
I'm getting you logged in. So your laptop is going to promote you to panelist. You just have to click yes, or I hit the key that shows on the screen. Let me know when you do it.
Okay, I'm in.
Great. And now you can just go to your presentation and do share screen.
Okay.
Share screen.
I'm not seeing it on here.
You go back to Zoom. Oh, go. You're logged in.
No, I'm in. I'm in. Yep.
So go back here and do share screen.
Okay, there we go.
And then it's going to show you every screen, and you just toggle it. Click. I know for a fact that this works.
Okay, it just lit up.
Okay, just pick your deck. Did you pick it? Get rid of that screen. And then, is that it? Yeah, pick that one. And then do share.
Sure. Yeah.
Now it should be popping up. Okay, it's got that.
Go back. It's not showing it.
Hold on a second. Wait. Nope, it's not showing.
Disconnected.
Yeah, it's been going on with the Wi-Fi right now here, but it should be up and running. 1 second here. Technical difficulties. It's reconnecting, so just give it a second here.
I'll go ahead and get started.
We're talking about all this tech and none of it works, so.
So I was really encouraged today when the emerging managers were talking about what they wanted to see from an investment standpoint.
John, you'd be talking to Mike.
Okay, so I was very encouraged about the emerging manager discussion today because I think we represent what you all are looking for in terms of a firm that's really trying to be a boutique investor in that RPM Living, who I'm a partner with, is the third largest property manager in the US. However, I work for the investment arm. We're really a boutique manager. We have $3.5 billion in owned assets, and we are currently raising a $250 million fund, which is relatively small for multifamily world. So we've been able to generate alpha consistently over time by focusing on middle market deals, smaller deals that are below, and these are all multifamily deals, so apartment deals that are generally smaller in tertiary markets and also primary markets. We've returned 30% gross IRR historically and over 90 full cycle exits. Is it working out, Marty?
I don't think it's going to pop up, so I'm going to use my laptop.
Okay. So we're okay.
You can just get going on.
Okay.
RPM, I got it right.
Okay. So this is an incredible time to be investing in multifamily because it rarely goes on sale. History repeats itself, as most of you probably understand. When rates went up dramatically, the fastest we've seen in history, it's creating a lot of situational distress. History repeats itself. Over-leveraged borrowers who bought at the peak 2 to 2.5 years ago They use too much debt. They bought at high prices. They have to refinance out. So our fund is taking advantage of that. We've been deploying over the last 12 months. You can stop there. We actually go to the next one. So we've been deploying over the last 12 months. We made our first investment in Dallas, which was a market that we loved, but we never bought in because cap rates were at 3% and we never found value there. So we are value investors, and that's helped us to generate consistently high returns over time. As you can see, $300 billion in multifamily needs to get refinanced this year, as well as the next few years. And so we see a lot of opportunity now, as well as we think it's going to get even worse in the value add sector. So we're looking forward to taking advantage of some of those opportunities. You can go to the next slide, Marty.
It just takes us a little bit of the water.
Oh, sure. So we are strategically located in the Sun Belt. So we manage 226,000 units. We're the third largest property manager in the US, in the Southeast and Southwestern United States. So we are firmly embedded in the best Sun Belt markets to invest in. So our acquisitions team is a 10-person acquisition team. We look at hundreds of deals a year to find the very few that we actually invest in. So we have a very robust institutional business, which is a separate line, where we partner with a lot of institutional capital, including Goldman Sachs, KKR, Carlyle Group, Walton Street, you name it. Right now, we're partnering with 15 to 20 institutional partners to do joint venture deals. So our fund has the opportunity to invest in some of those deals up to 20%. And in return for that, whenever we co-invest in those deals with larger institutional partners, we are bonusing back to the fund 20% of the profit we make on those situations, the GP profit that we make. So primarily the fund is going to be controlling its own deals, and we've made 3 investments thus far that we control, and I'm going to show you some of those so you can see the real value that we're buying nowadays. But we're focusing on the very best growth markets in the US, you name it. You saw them on the map, and some of our recent investments reflect those markets. From a risk mitigation standpoint, we're buying cash flow these days. We love the acquisition market, right? We're buying below replacement costs in some of the very best markets that we've not bought in the past because we're seeing such great deals. And that includes situations where a developer, he's built this deal in Dallas, he has to get out, his clock is ticking, he's used senior debt, he's used another layer of debt, and he just wants to get out. He'll lose all his equity in the deal, but he just wants to get out of it. So we've been feasting on that, and we've been buying deals. These are new deals below replacement cost, which is rare, especially in a hypermarket like Dallas, which has a very good growth outlook, despite having a lot of oversupply right now. So the vast majority of this fund is going to be cash flowing deals, and we've already started distributing. And so we've been distributing 4%. We should get up to 5% cash on cash in our next distribution. So that's a nice feature of the fund, is that it's going to have really good cash on cash, which is what we're seeing in the market right now. Because cap rates are higher than normal in multifamily land, we're getting really nice cash on cash. But we're not investing for cash on cash, we're investing for total return. So we're shooting for 15 to 18% net IRR. And that's basically the cash on cash plus the capital appreciation when we sell the deal. And the deals that we're buying are typically 3 to 5 year holds. So look, it could be quicker than that. So we're already starting to see some compression in certain markets. So we might have a situation where we exit sooner than 3 years. Let's see. Yeah, so going to the deals some of the deals we've invested in, there's 3 that I wanted to really point out today. I don't know if you can zoom in on that, Marty, but this is the first deal in Dallas. So one of the competitive advantages we have is we have so many relationships with other multifamily owners because we manage for so many of them. So we can buy directly from a lot of the owners. So we have private proprietary deal flow. This deal was a situation where the owner, it was really a smaller mom and pop. He built the deal. He had never sold it, which is rare, and he was giving back to society. He asked us to, we were actually managing it. He asked us to keep the rents artificially low because he was giving back to society. So unfortunately, he needed money because he was working on some other situations. He was building another deal in a different type of industry. And he needed the money. He knew we could close because we had a discretionary fund. And so we were able to buy it at a very attractive price of $131,000 a unit. And it's over a 6-7 cap in Dallas, which has historically been a 3 cap market or below. So it's extraordinary to find a deal like this where rents are $300 to $400 below the market, right? Because he was giving back to society. So we've since bought this deal and we've been getting 15 to 20% increases on rents since we took it over, just marking to market. So you hear the headlines about Dallas is oversupply, rents are going down or moderating, but we found this jewel that we're crushing it on the rental side because we're just marking to market and we're not having to spend a lot of money to do a value add. So we love a situation like this, which is very hard to find. And we got this because of our relationship. We put really good debt on it. We got Fannie and Freddie debt, 5 years. We paid 5.29%. So we will ride this one out. We think we're going to generate over an 8 cash on cash. And we look to exit well above our target returns. So, these are boring suburban garden style apartments, but, we've made the most money on these humble, boring suburban deals over time. So it's not the sexy deals that we've done the best on. It's these humble suburban apartments. So we love deals like this because you can't replace this either because this was built in 2001. We love workforce housing because there's a finite amount of it. Rents have to inflate over time because they keep getting improved. Rents keep going higher. And that renter world, right, keeps expanding and they want this lower price point versus all the luxury product that's getting built today. So we love this workforce housing strategy. And any questions on this deal before we go to the next one? Okay, Aspire Lenox Park. So I'm based in Atlanta and we bought this deal in Buckhead, which is the #1 submarket in the state of Georgia. So it's a very wealthy area. It's 1 mile from Phipps Plaza, if any of you guys have visited. And it's really hard to buy in this submarket because it's the best of the best. Last year, we started negotiating on this deal. It had an insurance company had owned the deal since 2014. It was the last deal in their fund, and they wanted to just get rid of it. They were price agnostic. It had traded multiple times and fallen out of contract. If you recall last year, the debt markets were very choppy, right? So we were hanging around the hoop. Our head of acquisitions had a relationship with the insurance company, and so we were able to buy it for $209,000 a unit. So this deal is fully renovated. It's a Class A deal in the best submarket in Georgia. We were able to pay we got it for a 6 cap, which is extraordinary in this submarket, fully renovated. Now we're going to make some improvements to it and tweak it, just change backsplashes, put in a tech package, just some really minor improvements to continue to push rents. But this deal is already appreciated in value because Atlanta's trading in the low 5s to high 4 cap rates. So this is already, we're already in the money on this deal in a very short order. So here again, another deal that we got because of our relationships. This deal we partnered with Marble Capital on. So the deal will get a fund level return, a deal level return to the fund, but also get 20% of the promote that we make on the with the co-GP relationship institution. So we think this deal is going to be a real home run. Any questions?
5 minutes left. Is this
Okay.
all of your deals Freddie or Fannie?
The vast majority of them. So we start, insurance companies are starting to get more active, but the vast majority have been Fannie and Freddie.
Right, because historically, we just know that, there's some more infrastructure on your part that's required, but most of the time that pays off.
Yeah, for sure, especially now because they've been really one of the few lenders in the marketplace, given the challenges with the debt markets. All right, let's go to the next one. So this next deal, Palm Vista, this is a real jewel. So this is a deal we also managed. It went to market in the fourth quarter of last year. A fund wanted to get rid of it. Here again, similar theme. It went through a marketed process and there were several bids. However, they were low. We negotiated with the institution to buy it at the highest price, and we're willing to pay all cash for it. So we were able to pay $74,000 a unit, which is extraordinary because this deal, although it was built in the 80s, it was hit by a storm and it was completely rebuilt 5 years ago. So we basically have bought this new asset and it's over an 8 cap and it's going to be over 10 average cash on cash over time in one of the best submarkets in the state of Florida. It's 5 minutes away from the Air Force Base, which is the biggest job generator down there. And you can't build this nowadays. So we think this is an extraordinary value. But here again, it's non-sexy, but it's a moneymaker. So these are the types of kind of smaller deals that we're putting into the fund. We bought it all cash, and we've had the good fortune of optionality on waiting to put debt on it. Fortunately, the market has come down substantially since we bought this deal in May. So we're going to put debt on it in around the 5% range, for 5 years fixed rate. So to buy an 8 cap and put 5% debt on it, it's pretty extraordinary. So this is going to be a nice cash contributor to the fund.
What would you say would have been the market value for these type of units? I mean, I guess they were rebuilt by insurance, right?
Oh yeah, probably double. They're smaller units, but double to maybe more. Correct. But they're smaller units and you would never build this style again. So it's kind of hard to say what replacement would be, but this is a ridiculous value. And I think for those of you who know multifamily out there, you understand what value we bought here. So the nice thing about the 9 investments that we made, and I know we're running short on time, is that we feel like all of them are in the money now just based on the interest rate movements within the last few months. The 5-year now is at 350 today. We've just seen an extraordinary movement in the long end, which was where we typically price our debt. So we're very excited about this fund. Here, you make your money on the buy. Timing is everything. This is the best multifamily market we've seen since the GFC. So we're very excited about it.
So we have time for a couple more questions. Do you have a question?
Yeah. Yeah, they're typically mid-90s, mid to low 90s. It really just depends. Sometimes we have different strategies where we want to really push occupancy, but we never want to be more than 95% because then we're not pushing our rents enough. So depends on the asset, where and the type. I mean, it just all depends. We have all different asset types in a lot of different markets, Class A, Class B. That's all we're really buying is Class A and Class B. But it's nothing like New York rents. These are Sun Belt markets, but they're healthy returns. Yes?
Can you address the insurance aspect? You said that you have a catastrophe and the insurance is going to put up some of the money.
Yeah.
Are you actually getting the money or are you buying the money, so to speak, and using that as a basis to renovate?
Well,
that's kind of the deal with the insurance company. You get forced down so that you can renovate at a cheap price, maximize return.
well, all policies are different, but typically they have to pay for replacement. So that's in this case, when the hurricane hit, we actually managed to rebuild. So they had to bring it back to sort of its original state. So, oh yeah, absolutely. Because I mean, it's almost a good thing. Sure, it was a tragedy and it was very arduous to rebuild it, but we basically got this new asset at a song. So even though it was built originally in the 80s, but it has all new electrical, it has all new appliances, all new interiors. So it's like a brand new asset. So it's an extraordinary value. Can you go one more, please, yeah. Marty? And so that's more market information. I think we talked I know Peter talked a good bit about the market today, and the vast majority of money that's going into real estate right now is going into multifamily. So we think that's a good sign. And there've been a lot of recent trades, which you all have probably heard about. Blackstone made a big purchase, $10 billion AIR portfolio, as well as KKR also bought a big portfolio. So a lot of the big institutional capital is getting very active again. So we think it's just a matter of time before cap rates continue to go down once rates really start going down as well. So we think having bought so many good deals in the last year at high cap rates, we're going to get really good compression on this portfolio. And we're very excited about the value add that we think is going to be coming in the next 6 to 12 months. Distressed deals. Any other questions?
I thought was really some great points you made about this housing shortage and that even in 2008, I guess it was a million homes were built every year, and
Yeah.
we've fallen far short of that right now. So.
Yeah. So we're getting a wave of supply right now in some of the major markets, but we are still structurally undersupplied. JLL has a really good slide, which Marty was showing. And once this supply delivers, so most of it's going to be delivered this year through maybe the start of next year. But after that, there's going to be a supply disruption because of all of the development deals that have been canceled because of the high cost, because of interest rates, and the banks have stopped lending. They have too much CRE exposure. So that's going to create another shortage in the next few years, which we're going to be selling into. So here again, everything is setting up in terms of riding the cycle at the right time to exit at an appropriate time and maximize our returns. So we really want to build on our 30 IRR, gross IRR over time, and hopefully this market's going to help us do that. Any other questions? Yes. The question was, if Fannie and Freddie become privatized, how is that going to impact the market and our strategy? That's a really hard question to answer. I think there's a lot of other lenders in the market. And quite frankly, Fannie and Freddie were not competitive 2 years ago at the peak. It was all the debt funds. It was all the banks. So it was, when things are good, there's too much money, right? So Fannie and Freddie are great when times are bad because they continue to support the market. And that's the beauty of multifamily, is that we have such active support from Fannie and Freddie. But that's a tough question to answer, but I wouldn't think they would change it that much. But we're seeing more and more lenders get active in the multifamily market, which is good.
Looks like you're doing some great deals.
Thank you.
I have more questions for you, but we're out of time.
Okay.
And I'm going to ask them at dinner time. So
Fantastic.
this is great stuff. Thanks so much.
Thanks again for the opportunity.